Welcome back to Investing Talk Podcast.
Today we're looking at intuitive machines.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The core story here is a massive transformation.
A transformation? How so?
Well, they're shifting from a really focused lunar services company into, well, a broad-scaled space prime.
And that transformation is being driven by a huge strategic move, right?
Exactly. I mean, the catalyst is the company agreeing to acquire LUNR Space Systems for $800 million.
Wow.
Yeah, that's $450 million in cash, $350 million in stock. This one move immediately changes their entire profile.
So just how big of a change are we talking about here in terms of scale, I mean?
It's a massive change.
Yeah.
Before the deal, the company was, much smaller, really just focused on lunar delivery. After the acquisition, management is projecting the combined entity will have revenue exceeding $850 million a year.
$850 million.
And this is the crucial part, a really robust backlog of $920 million.
And that's up from what, about $236 million before?
Exactly. So that shows a huge increase in their revenue visibility.
So that backlog and revenue shift, that really moves the company from being sort of an early stage growth play to a major government and commercial contractor.
That's it. You've hit the nail on the head. Now, the financial picture is it's complex. It reflects a high-growth company in a very capital-intensive sector.
Right.
On the positive side, revenue growth has been explosive. I mean, up 187% year over year to $228 million in 2024.
That triple-digit rate, that's got to be from strong government contract traction.
It is. But here's where it gets really interesting. Despite all that growth, the company has, historically been operating at a loss.
Yeah.
So what's the profitability picture look like?
Yeah, that's the key question.
Standalone, the company is loss-making. They've reported a deeply negative EBIT margin and negative net income in recent quarters.
So they're burning cash.
They are burning operational cash, about $57.6 million in 2024, as they scale up production and mission execution.
So how is this rapid scaling being funded then? Does the balance sheet even support this kind of expansion?
Well, this is a key bullet point. The balance sheet strength has transformed dramatically. As of September 2025, the company held $622 million in cash and equivalents.
$622 million, that is huge liquidity. Where did that capital come from?
It came from two major moves. First, the company successfully raised $345 million via convertible senior notes back in August 2025.
And that debt, what are the terms?
Very favorable. It carries a very low 2.5% coupon and doesn't mature until 2030. That gives them a multi-year runway.
And the second move?
Second, they used proceeds from warrant exercises and some equity offerings. This liquidity is absolutely key to funding the cash portion of the LUNR acquisition and managing that operational burn until they can hit profitability.
So the path to profitability is?
The critical turnaround catalyst is the LUNR acquisition itself. Management states the combined entity will have positive adjusted EBITDA.
Okay, so what that means is the business they're buying
is expected to be cash generating, yes. It should offset the standalone operational losses, providing a very clear path to profitability.
Got it. So moving beyond the financials, let's talk about their competitive edge. What is their moat in this emerging space economy?
I think their primary moat is their proven flight heritage.
Right.
I mean, they're the only company to successfully land and operate a spacecraft on the moon. That IM-2 mission.
Even with the lander tipping over, yeah.
Exactly. Even with that incident, it successfully demonstrated autonomous operations and, crucially, delivered customer payload data from the lunar South Pole.
And that proven capability that just de-risks future NASA contracts against competitors.
Massively. And on top of that, they are deeply embedded with NASA. They hold sole source contracts for direct Earth services for cislunar operations.
Sole source. So that effectively blocks competitors from some key government infrastructure roles.
It does. And it provides multi-year revenue visibility.
And how does the whole vertical integration angle play into that?
Well, the LUNR deal, combined with the KinetX acquisition in August 2025.
Which added that deep space navigation expertise.
Right. It positions them to control the complete cislunar stack. You're talking lunar landers, satellite buses, data transmission, and navigation services.
So they're a vertically integrated, multi-domain player.
Precisely. which creates switching costs for customers like NASA. They're essentially becoming the full-service infrastructure provider for the emerging space economy.
Okay, but we have to acknowledge the risks.
We absolutely must. And the biggest one remains mission execution. Despite the IM-2 success, they have had those tipping incidents on both IM-1 and IM-2.
And a failure on the next mission could trigger contract delays
Or a collapse in investor confidence. It's a real risk.
So what are the mitigation efforts for that execution risk? Are they just crossing their fingers?
No, not at all. Management has implemented hardware and software upgrades for the next mission, IM-3. And the landing site they've chosen, Reiner Gamma, is considered significantly easier terrain than the South Pole.
So if IM-3 lands upright, a lot of that risk is substantially reduced.
It is.
What about customer concentration? That seems like another big risk, given the government focus.
Correct. NASA represents 64% of their accounts receivable. That heavy government dependence exposes them to, budget appropriations risk, policy changes.
But the mitigation for that is the LUNR acquisition.
That's the idea. It immediately diversifies the customer base across national security, civil, and commercial clients, which reduces that single program dependence.
Okay, let's talk about the near-term catalyst then. What could drive the stock price in the coming months?
The most immediate one is the IM-3 mission launch, which is expected in December 2025. Its success would validate their production readiness and their mission cadence.
And after that?
Another one to watch is the IM-2 Nova C Athena launch window, which opens in February 2026.
And beyond the actual missions, what other news flow should listeners be monitoring?
Two things. First, any updates on the LUNR deal close? It's targeted for Q1 2026. And, of course, the financial consolidation updates that will follow.
And second?
The potential $1 billion+ lunar terrain vehicle contract, down select. That's expected to lead to developments starting in 2026.
And it seems sentiment is already reflecting some of this optimism. I saw some news about significant insider flow.
Yes. A director, Michael Blitzer, recently bought $2.19 million worth of Class A stock in November 2025.
That's a serious vote of confidence.
It is. That level of high-conviction insider buying, especially against the backdrop of prior share price volatility, suggests really strong confidence in the medium-term outlook, particularly after the LUNR announcement.
So if we connect this to the bigger picture.
If we connect all the dots, the company is transitioning from a high-risk, pure-play lunar concept to a vertically integrated space prime with substantial visible government backlog and a fortified balance sheet.
So the key is monitoring their ability to execute missions and integrate LUNR.
That's it, to achieve consistent, positive operating cash flow. And this raises an important question for our listeners. In the new space race, which is more important, proven technology or scalable manufacturing capacity?
A great thought to chew on. Thanks for the breakdown. If you enjoyed this analysis, please make sure you subscribe to Investing Talk podcast for more breakdowns like this.